manage a global macro hedge fund, a long short, and a precious metals focused fund. We've been very vocal commodity bulls. I think we've been facing some profound changes in the global economy that I think will unleash a plethora of early stage secular trends. I'm going to be talking about some of those. I think contrary to most pessimistic views out there, I believe we're about to unleash. I think this is one of the most exciting times to be a macro investor right now. I like to think that we have popularized a little bit of the process of thematic investing, where we detail a lot of analytical work that leads us to identifying long-term macro trends. And hopefully I'll share some of that. So let's dive in to some of those. I think this is a huge part of our thesis as far as what predicated on the central part of most of our investments. It has to do with the trifecta of macro imbalances that we're facing right now. We have the debt to GDP problem of the 1940s. We have the inflation problem of the 70s. And we also have the speculative environment of the 1920s and the 1990s. And those create true political constraints when it comes to policy making. And I think that's what creates a lot of the opportunities ahead. One of the biggest debates in the macro world, I think, it's if inflation is cyclical or structural. So let's go through some of those charts that I think it's actually structural. First, it has to do with the growth in wages and salaries per employee person. It's looking at a 24-month change. As you can see, I think we're at the beginning of a secular trend like we saw in the 60s, all the way up to the late 70s. I think this is a major reason why inflation has been so cyclical all the way back to the last 30 years. The second one that I think it's even more important, it has to do with natural resources and why we got so bullish on commodities in the last 3 years or so. It has to do with the majority of capital chasing different parts of the market. As you can see in this chart, global equity market is at about $120 trillion today. Natural resources at about $10 trillion. And if you exclude energy, we're about $3 trillion. I think that's a big reason. If you go to the next chart, as you can see here, it's just looking at the difference of technology companies versus commodity producers. I've been seeing this chart now in different versions of this chart on Twitter. I like to think that I was the first one to put it out, but I'm glad to see other people thinking the same way. There's a lot of capital chasing sexy industries like technology companies and forgetting about the basic necessities of running a global economy. And so we've seen this divergence between the two charts all the way back to 2015, where commodity producers have been not investing enough. I think there's a couple reasons for that. The next chart is something I posted today, which I think it's incredibly important. It has to do with, I don't care if you think it's related to extreme conservatism or it's something that has to do with political efforts against capital spending in commodity producers in general. But this is the first time we're seeing CAPEX trend very close to how much companies are spending on dividends and buybacks. And so I think this is a big reason for the constraints that we're seeing right now. And the second part of this has to do with the extreme conservatism by most of those corporations trying to attract shareholders by making those companies more attractive by paying more dividends. We're also, I think the third pillar of inflation that I think is so important has to do with the fiscal spending. We're seeing the largest fiscal spending we've seen compared to where unemployment rate is and also compared to where inflation is. This is, I think, what's going to be one of the big lessons of where fiscal policy is relative to the inflationary implications of all that. One of the things that I don't think anybody's paying attention to, but the last 3 months in terms of changes of government spending, if you exclude 2020 and 2021, which we saw those major cash handouts from the government, this was the largest 3-month change in government spending in history, or at least all the way back to as much history as we can get. And this is adjusted for inflation as well. It is really astonishing that no one is really talking about that. One of the things I was looking at today has to do with the government debt situation, how much it increased of issuances of debt, but also the outstanding debt that we saw back in the global financial crisis, about $1 trillion. And today, We just saw that in the last 5 months. It's the same amount of debt increase that we saw in the middle of the global financial crisis. One of the things is how extensive the fiscal agenda really is. I mean, it has the green revolution, it has the peak inequality problems, it has the geopolitical tensions now driving defense spending. And if you look at this chart, defense spending at about 3.3% used to be somewhere close to 9% all the way back to the 60s and 70s. I think we're going to see a lot more here. And I think that's one secular trend when it comes to investing in defense companies. I know this is maybe, there's some ethical reasons where people may not invest in those companies, but I think that's going to be unleashing somewhere close to $1 trillion to even $2 trillion of defense spending, not only in the U.S., but other NATO countries. And I think U.S. companies will benefit tremendously from that. Crescat is invested in a few of those as well. The other thing that I think it's going to happen with deglobalization trends that I think is the fourth pillar of inflation and why I think it's so structural, it has to do with the manufacturing situation. I think back in the 70s and or 60s or so, we used to have manufacturing somewhere close to 30% of GDP, and today is just at about 10%. I remember when Donald Trump came in, I thought we're going to see some of those changes back to the U.S. I don't think we saw much of that, but I think we're going to see this time around. I highly doubt we're going to see a company setting up their businesses in the U.S., creating a long-term relationship to a country like China in order to operate for the next few years. And so I think we're going to see non-residential spending when it comes to construction in the U.S. that is going to drive the second wave of commodities as well. One other thing that is related to the fiscal spending has to do with the net issuances of treasuries. I think net issuances of treasuries is something that not a lot of people are paying attention to, and it has to do with not only the extensive fiscal agenda that we have, but the lack of buyers. We're seeing the deglobalization trends. It's making it harder for foreign investors to purchase treasuries. We're seeing not enough the banks, U.S. banks buying those instruments. At the same time, back in the 40s, for instance, when we had a lot of issuances of treasuries, households are buying a ton of those instruments. Today, I don't know any household that is buying war bonds or anything related to those instruments financing the government with this massive fiscal spending. Correlations are changing in the markets right now because we're seeing an inflationary problem. And I like to think that we're now entering an environment where the monetary stimulus and monetary policy in general is going to become highly destructive. It doesn't matter what you do. If you tighten monetary conditions, you're going to risk a reckoning moment in financial assets near record valuations. You can also reduce the availability of credit and capital for producers in order to stay in the game and provide natural resources for the global economy. If you loosen financial conditions in an inflationary environment, I think you all know what's going to happen. But interesting enough, what we had back in the late 60s and the mid 70s was equity markets were declining at a time when 10-year yields are actually rising at the same time. I do think correlations are about to change significantly, and one of the secular trends that we may see is the removal and the changes in capital allocation when it comes to the 60-40 portfolios. I think gold's going to play a big role into that. One of the fallacies in equity markets today is that inflationary periods are very positive for equity markets. That's not true. Back in the 70s and back in the 1910s, the real return for equity markets was actually negative in real terms. We can also look at the 40s as well, but the 40s was more of a sporadic inflationary problem, much more cyclical than what we have today. I don't think it's as comparable as it is with the environment that we have. The dollar was pegged to gold at the time. That's certainly not the case today, what we're seeing when it comes to monetary policy. I also think we're at the peak of the business cycle, which makes me think about profit margins at peak levels today and ISM manufacturing starting to roll over. Let's look at some other charts that I think are related to this. CAPEX. Companies tend to spend a lot of capital at the very peak of the business cycle, as you can see in this chart, looking at CAPEX over a history of excluding energy and financial companies. And today, the guidance for 2022 CAPEX is higher than any other time in history. Heavy truck sales, it's an interesting metric that I think I would point out as an uncanny relationship with predicting recessions in the past. We're now down about 23% in this chart, as you can see. I think this is another reason to believe that we perhaps are going to see a major deceleration of growth. Consumer confidence, when you look at present situation relative to expectations, this ratio is now spiking. In other words, expectations are starting to fall while present situation when it comes to consumer confidence remains really high. Every time we've seen this ratio at a high level, as we've seen right now, we've seen a cyclical downturn. I also think that one of the most reliable contrarian indicators you can find is mostly in labor markets. Every time labor markets are tight and look very strong, usually you see the downturn in equity markets. Right now, continuing jobless claims is at one of the lowest levels we've seen in history. Savings rates as well, if you see the year-over-year change is down about 80%, you may say, well, but that's because a lot of the handouts came out in 2021 and it's causing this real change. If you go to the next chart, as you can see, percentage of savings relative to disposable income, we're also at a multi-year low when it comes to that as well. And so what is going to be funding most of the consumer spending that we're going to see in the following years? I highly doubt we're not going to see a recession here the next 1 to 2 years. And so if there is a recession and we think we're going to change a little bit of correlations and treasuries are not going to play a safe haven aspect as it did in the last 2 recessions, what is it going to look like? I think it's important to go back to 73, 74 and think about what gold mining index did at that time. Believe it or not, it went up about 5-fold as the 1973-74 crash caused the S&P 500 to decline over 50% at that time. Today, we have NASDAQ down about 27%. That is almost as much as we saw the decline in 2020. Back then, everything was about how to save the economy. I don't think that that's the case what policymakers are claiming today when it comes to policy. Let's look at corporate bonds. Corporate bonds in terms of total return, we saw a decline of about 15%. The Fed had to come in to rescue most of those. Sure, a lot of the decline today has to do with the maturity side of it, not so much the default risk, but I think we're going to get there. We're down about 15%, and I think there's going to be a lot of more ramifications to that. When you step back in history and you think about valuations, which when cost of capital begins to rise and you think about inflation being structural, you got to think about valuations a little bit more. I think fundamental analysis is another trend that is going to come back where value investing is going to be prevailing relative to growth stocks. And when you look at market cap relative to GDP, even with the decline that we saw recently, we're still 15% above where we saw back in the tech bubble. Here's the Dow Jones in gold terms all the way back to 1929, same level that we saw back during the speculative environment of the late 20s. Here's my views about the equity markets. I think growth is going to continue to underperform value stocks, and I think natural resources will continue to do very well in this environment. I think we're just at the beginning of that trend. Technology sector is one of the biggest parts of the growth stocks. As you can see, growth stocks right now relative to the S&P looks like a double top retesting the tech bubble. Same idea. One of the biggest things I hear is that technology companies are extremely profitable. Well, if you look at the real free cash flow yield today, is below where we were with the tech bubble. The second thing I talk about is not only the profitability, but it's the valuation you're paying for those businesses. PE ratio on a median basis for the top 10 largest stocks in the US are actually higher than it was at the peak of the tech bubble. Here are the FANG stocks revenue growth. Crescat is short most of the technology stocks and the FANG stocks, by the way. Apple is one of our biggest shorts. Yeah, we did get hurt today, but it's part of the game. Percentage of non-profitable stocks relative to looking at software companies. Software companies is a big part of our attribution when it comes to the short side. We've been short software stocks for over a year. The profitability is dismal, as you can see over the years. It's close to 40% of those companies are actually not making any money. What is amazing is this change in leadership in the markets. We're seeing energy and natural resources beginning to actually lead the way to the upside as we see the pullback in other sectors. So you see the rest of the market, all the other sectors versus energy. Energy and E&Ps had their best year in 2021 over more than 30 years. Here's the commodities cycle, and I don't believe this is 2008 at all. Sorry, I'm speaking fast because I have a lot to share. Commodity producers. Back in 2008, we saw CAPEX cycle as you can see in this chart, somewhere close to $450 billion that most of the capital spent on from commodity producers at that time. Today, we're a 19-year low adjusted for GDP, which I think is the right measurement to do. Here, the commodity producers' free cash flow, they're generating somewhere close to 4 times what they did in the prior peak when it comes to peak, not on prices, peak on fundamentals. So If you looked at it on a relative basis, just looking at energy for now, this is the CAPEX for energy today. I think we're seeing governments trying to spend now or pass a bill to spend about $40 billion in Ukraine. $40 billion is exactly what the E&P companies spent in 2021 on CAPEX. And I really think that what we're going to see as another trend is that the government's going to get involved with helping a lot of developments in natural resource companies. That's a discussion for another time. Energy stocks free cash flow yield, as you can see, we're trading at about 9% despite the increase in prices that we saw last year. This is an incredible opportunity for us. Energy sector, one of the most important sectors in the economy now, when you looked at the weight in the S&P 500, just at about 3.7%. Energy stocks, when you look at free cash flow yield on a spread relative to the S&P, one of the cheapest levels we've seen, going back even to the tech bubble, cheaper than it was back then. This is Apple relative to energy stocks. Apple is actually now about $2.4 trillion. It's a bit less than that, so less than 40%, but about, let's call it 30% market cap of the entire energy sector. But the energy sector makes about 50% more in free cash flow than Apple. That's just the absurdity that we're seeing in equity markets today. The erratic fiscal policy that we're seeing in regards to selling petroleum reserves as we see oil prices continue to rise. I think this is going to be very costly, with oil production down about 11% since pre-pandemic, while GDP is 9% higher. One of the biggest things that I think are the importance here and why we see so many inefficiencies in exploration assets is because of the global trends in labor markets. There's a difficulty of finding good labor and professionals that can actually have the competence to lead some of the companies that we invest in today. We like to think that those changes are going to create major opportunities, and that's why we're involved with most of the commodities. For every dollar that is coming into the commodities market, or to the equity markets, only about 9 cents is going to commodity producers. From those 9 cents, only 5% is going to precious metals. It's amazing what's happening when it comes to that. Precious metals, when we look at operating margins among commodity producers, about 27% on a median basis. You can compare that with lumber, base metals, oil and gas, coal, soft commodities. We own a basket of all commodity producers. However, we do favor precious metals over many others. We had silver pulling off recently, having a pullback recently, which I think, I continue to accumulate assets in the space. Crescat has never been so busy, buying more assets, especially silver related. Some of them are actually in this conference. Miners to gold ratio, we've had an issue with mining stocks declining significantly in the last few weeks. I don't think this chart has done any damage so far. CAPEX relative to gold prices is still a major difference that we think portends a lot of opportunity when it comes to what's happening in terms of the spending. We're not seeing enough exploration budget relative to where gold prices are. Actually, gold prices are much lower than that. This chart's a little old, but exploration budget has not changed much. And one of the reasons that we're so concerned about this is the lack of discoveries that we're seeing in the gold space. That is a real problem. We're also facing some supply cliff in some of the major companies. I think most of you know a few companies that may actually need to acquire other assets that are high quality in exploration phase and development phase in order to feed or replenish their production going forward. The profitability of companies in the mining space is incredible. They're making somewhere close to 7% free cash flow yield, and it's something we've never seen in the past. Profitability among the industry, about 70% of them are actually profitable on a free cash flow basis. I really apologize for going quick, but I really have a lot to share. I'm going to try to, since I have 1 minute, I'm going to try to share some of the macro trends that I think are going to happen, that I think are important for investors. I'm going to lay them out. I think the governments and central banks are going to seek high-quality international reserves to improve the credibility of their currencies. And so, therefore, I think gold is going to play a major role into that. I think tangible assets are going to regain a relevance when it comes to crowded 60 and 40 portfolios. And I think they're going to play a very important inflationary hedge. Central banks ultimately will be forced to cap long-term yields, creating a major tailwind for inflationary assets. I think commodities are going to get the second wave, especially gold, once that happens. The beginning of a commodity cycle after a chronic underinvestments in natural resources, I think that's a real trend. A new exploration age. I think we're going to see that happen as we have this supply cliff going on. Deglobalization trends that will prompt a long overdue manufacturing rebuild in the U.S., and I think it will boost non-residential construction. So you think about steel producers and so forth. Rising geopolitical tensions. I think it's going to spur defensive spending, and I think that industry will benefit tremendously. The rise of global interest rates due to a flood of issuances of different sovereign debt instruments. I think that's also due to the persistent inflationary problem. Overall, corporate margins are going to get squeezed, in my opinion, and that's because of the rise of cost of capital, commodity prices, and labor cost. Finally, the resurgence of fundamental analysis and value investing principles as the profitability becomes a priority again and not growth. The repricing of long-duration assets, especially growth stocks, from near record valuations as cost of capital begins to rise. A significant shift in market leadership, as you were seeing with energy versus the rest of the market. I think that will continue. Geopolitically neutral and commodity-driven economies, I think, will regain relevance, and I think Brazil is going to play a big role into that. And finally, the upcoming challenges for historically indebted economies that have net importers of commodities, i.e. China and Hong Kong as well. Happy to discuss more of that if you have any questions outside of this presentation. Hope you enjoy it. Thank you.